Ladies and gentlemen, welcome back to PwC's Risk and Regulation News Channel, and welcome back to our special video edition about securitization. Today I have again two really good experts with me. They are both the co-workstream leads of our securitization workstream in the EBA SSM office. You know them both already from our previous videos. It's Christoph from our German office. Hi Christoph.
Hi Martin.
Nice to have you here again. And Gabriele from our Milan office. How are you?
Hi Martin. Fine.
It's so wonderful to have you both here again on board. Especially because we have a special topic today. Today we will speak about how securitization can help with the topic of NPE management. But before we go into the detailed topic on how securitization can help within NPE management, we have to ask the question, is NPE really a topic right now? Why should we think about it? Christoph?
Yeah, there are different opinions on it, but I believe it's definitely worth considering NPE for a moment, and let's decide afterwards whether it's a topic for a very individual bank or not.
Yeah.
What I want to share with you today is a couple of statistics in the very beginning. Don't want to bother you too much, but there are a couple of indicators telling us there might be a problem in the future with NPEs. Even in countries of Europe where it wasn't a problem until now. So there are some numbers here on this slide. For example, we see in the EBA stress test exercise, which was closed in summer, and the results we published there, that there is an increase anticipated until 2027 of 78 billion in terms of CET1 deductions. So across all participating banks, 78 billion increase in CET1 deductions. This is directly deducted from CET1 based on the so-called NPE backstop, which is the insufficient coverage of NPEs according to the CRR. And this is publicly available, so probably the numbers are wrong, but then it was published wrong. But this is what we identified. I will tell you some more details in a minute.
Yep.
When you look at German banks, and we have a couple of discussions with German banks about NPEs, they in general say, well, the NPE ratio is very low. We don't have an issue with NPEs. But even there, we see a significant increase in these NPE backstops. According to the stress test results of in total 11 billion of all participating German banks. So 11 billion CET1 will be, will be diminished by the end of 2027 in this unmanaged scenario, of course. And the last number here is the volume of NPL. So it's not the NPE exposures, but NP loans specifically. And also here we see some statistics indicating that we have a huge increase to expect in the next few years. And we also saw it already in the last few years. I would say starting after the Corona phase, when all these state support was over, we saw a significant increase in NPLs of over 50% in the German banking market. So this is already something. It's still a low level, but it was already a huge increase. And let's assume for a moment this will continue because the macroeconomic outlook is not the best, and the geographical risks are rising. So these are three numbers to consider for a moment. What I would like to do, because probably not everyone is into this NPE backstop topic, I would quickly remind you of how this NPE backstop, insufficient coverage of NPE, works. In general, you have a non-performing exposure and you have a balance sheet coverage. So you have loan loss provisions covering the NPE, and you have a remaining part. And the supervisor now tells you, or the regulator tells you, to cover this remaining part over a couple of years. At what time it is, there is this vintage calendar provided in the CRR. For collateralized parts, it's 7 to 8 years until you need to cover it fully. For uncollateralized parts, it's after 3 years you need to have a full coverage of this remaining part, which means coverage in terms of regulatory capital. It's the CET1 deduction in the end. So no P&L impact like it's for provisions, but it's definitely directly deducted from CET1, a significant impact, I would say. So this is the the overall methodology of the banks, of the backstop. Show it here on this slide on 2 examples. The upper one is for uncollateralized exposures. You see it after 3 years, you have a full coverage. Full means in it when you combine the balance sheet provisions and the CET1 deductions, the full amount needs to be covered. For the second example, in the lower part, you have a collateralized exposure, and for the collateralized part, you have this ramp-up phase over a couple of years. So this is as an introduction for the methodology.
Christoph, if I can add one point, it's not only the backstop, but also the supervisory expectation.
Exactly.
Because they lowered in time the expectation. At the beginning, to us, if you remember, 7% was considered like a good level. Then EBA moved down to 5%. Now it's widely considered 3% as a target level, above which you should start to focus on the situation. So the expectation is really high now.
Definitely something that we hear from a lot of SREP meetings with the ECB also, but also with the national competent authorities, that there is a quite strong focus on NPLs, and that the banks have to start managing it. Yeah, definitely.
That's true. When we look a bit into some more details of the stress test results, so very recent numbers. Here you see the top 30 affected banks according to the EBA stress test results. What you see in this light-colored column, it's probably not even seeable here in this slide. It's the current level of NPE backstop, so the CET1 deduction. For many banks, it's like I don't know, something between 50 and 100 million CET1 deductions, so it's really not of importance at all. But there's a significant increase anticipated based on the stress test results in the baseline scenario until 2027. So as of December 2027, in this unmanaged baseline scenario, many banks are affected to a significant amount. We didn't publish the names here, but they are publicly available. If someone is interested, you can look it up in the EBA results. But what you see here, there are banks affected by, I don't know, 5 to 8 billions.
That are total. Huge amounts. Yeah.
Huge amounts. And also German banks, you see it, for example, there are some German banks in the middle of the graph. There's also a billion or 1.5, 1.8 billion. It's not unusual that you see those effects. So the little dots that you see are the NPL ratios. They, according to the EBA publications based on 2024 data, they look very stable, I would say. They are about like between 2 and 3.5%. So probably nothing to worry about at the moment. But when you see the anticipation based on the existing stock of NPEs, and this anticipation of transitions from stage 2 to stage 3 loans, as it has to be done during the EBA stress test, then you see what it can be. It doesn't need to be that like that. Of course, it's an indicator for
anticipation is important. Yeah.
Exactly. So this is one interesting point. I here also show some developments of the NPL ratios and non-performing loans and advances according to a couple of statistics that are publicly available. And I would like to highlight a bit the focus on Germany, because also here we see, I mean, it's on total average, it looks quite stable. But when you see a look at the last 2 years from June 2023 until June 2025, you see an increase of almost 30% of non-performing loans and advances. And this is something that we need to consider. Also, when we look into the future of the NPE backstop, you remember this vintage calendar. It's not a problem as of today, rising NPLs, but it will become a problem in 3, 5, 8 years, right? And this is definitely something to consider. What I also found very interesting is the level of NPL coverage based on the balance sheet statements. And also here we see not too much, but there are some differences. When you look at the German coverage ratio, it's below 40%, something between 35 and 37% on average, while for Italian banks, for example, for Spanish banks, it's way above 40% coverage. And this drives the NPE backstop quite significantly for German banks as well. So this overall is the the picture that we see from the EBA stress test. But I think what is also interesting is to what are the other indicators for anticipating the NPL development over the last couple of years. And Gabriele, I believe you brought some statistics also from the more accounting point of view that you can show.
Yes,
no.
As you were mentioning before, stage 3 is not the only. Of course, we need to look at NPE, but it's not only that. If you see stage 2, which does not mean that is per se dangerous position, you should distinguish between the stage 2. But of course, it's the position that have increased the risk in time. So potential, say, signal at least. If you see also the stage 2, you can see at the European level almost 2 trillion of assets, which is a lot. Of course, just a small portion of stage 2 will go to NPE, but even a small portion of this is still relevant. And if you see the coverage of stage 2 is very low. So if the coverage is between 1.7 in Germany to, let's say, 7.6 in Portugal, but still is quite lower than the NPE, which is around or up over 40, which means two things. If the position will go to NPE, you will need to increase the coverage a lot. And then, as you were mentioning, also the calendar will start to go. So a lot of attention, because this is an asset class which is difficult to interpret, but a potential sign for future flows of NPE.
Yeah, I think what is important to consider is, and that's why I'm also so happy that you are here with us today. When we look to the last 10-15 years, we must admit that the Southern European countries simply have much more training and experience with NPE management. I mean, you were coming from extremely high NPE ratios, bringing down to a European average. While in the Northern European countries, luckily, the topic was not such a big one, of course, but it becomes now much more important. And so it's good to learn from the Southern European countries how you managed that challenge. Yeah, and that brings me to my next question, Gabriele. Maybe based on your experience over the last years, what are the best solutions to manage non-performing loans, non-performing exposures?
Yes, Martin. As you were saying, Italy was one of the most hit countries from a credit point of view in the last crisis. So we had big stocks of NPE, which reached almost the 20% of the books at a certain point, which was bad. But it's good that now we developed quite a good ecosystem to manage with different solutions to manage the NPE topic. So the first and more straightforward solution is to sell off portfolio. But usually it works for a simple or less developed market because it's clearly you need to have an investor who has the liquidity to buy the portfolio. You cannot diversify risk, so it's quite it's okay, but I would say it's okay if you have smaller portfolios. Then we have some more developed solution, which goes from the traditional securitization, and it's why we want to tackle this topic today.
Absolutely.
The main alternative to securitization, which is the fund. And then one structure which was quite common, which is the creation of platform NPE, which we will see in a minute, which usually entails any hour securitization for the portfolio. Okay, so if we go 1 second, why it's important the instrument of securitization within the de-risking activity of a bank? Because in this way you can really reach different classes of investors. So you can have the equity investors. Often the bank retain the senior part because it's low absorbing. And for instance, in Italy and Greece, there were also some state programs that guaranteeing the senior, which means zero risk weight for the bank. And you can have this mezzanine tranches if you want to optimize the structure. So in this case, you can really, to securitization, sell also large portfolios because the investor does not need to have all this liquidity.
Of course.
And you should diversify the risk. So I would say these two advantages. You can have a more scalable transaction because you don't ask to the counterparty to have the liquidity, and you can diversify risk, optimizing the investor to whom you sell the. A potential alternative is the credit fund, where sometimes the bank is themselves or the investors. So the important is that you reach accounting the recognition. So the bank can be both seller and buyer sometimes. Sometimes there are investors which are third parties. Differently for securitization, the fund is somehow easier to set up, a bit more flexible, in the sense you create the fund and then in time you can sell your portfolio, make other investors enter, etc. But on the other side, does not have all the advantage of the securitization. So you cannot diversify the risk. You cannot basically make a leverage transaction on this. So it's two different solutions depending on which is the main focus you want to obtain. You want to lose less value, you create a fund and you retain the quotas. You want to maximize the price, probably you do a securitization. You want to do something flexible, maybe you do the fund. And for instance, sometimes the funds are used also for the UTPs. So when you need to have also new finance or some position which are maybe will go back to bonus. So again, the funds can make you a bit more flexible, the management of all these topics. A third solution, which is a bit of a more evolved version of securitization, is to do the securitization of the portfolio, sell it to the investors, so the process is basically the same, and then ensure of course the investors will select a servicer to manage this position, and then you do a partnership with the same servicer, selling the operating unit and making a long-term agreement with the servicer. Which are the advantages of this? You create a structured and industrialized unit to manage securitization, because usually maybe banks have not the main focus on this, while if you do this, you create a separate unit which will manage this. Secondly, you kind of not solve, but you kind of put the basis to manage the topic in the future, because for 10 years you will know which is how the management of NPEs will happen. And third, of course, you attract more investors, because if you have this long-term agreement, you attract more investors, you have a higher price up front, so that you usually have a loss when you do a NPL transaction, but in this way you minimize the loss. So I would say this is more complex, but is more efficient from a price point of view, and especially from an industrial point of view, because at this point you kind of try to solve the management problem for the next years.
Perfect. Thank you so much, Gabriele. Thank you so much, Christoph. I think what is very important is when we speak about securitization as an NPE management instrument, that there might be one-off transaction. So when there's urgency, then of course we as PwC, we can support you in organizing this transaction as quickly as possible. But as we have heard now from you, Gabriele, there's a lot of experience, especially in the Southern European countries and within our PwC network. I think that's the important thing. So we can also support the clients in industrializing their NPE management, and it doesn't matter if it's now a securitization transaction, a fund transaction, or anything else. But it's important to have support with experienced consultants. And again, we as PwC, we can support you from the beginning to the end of this transaction, and also we can support you on the sell side and on the buy side. So again, thank you very much, Christoph. Thank you very much, Gabriele. And thank you very much, dear viewers, for attending this video. And do not miss the next video in our securitization special video series. Bye-bye.